So our next presentation will be Planning and Saving for Retirement. This will be presented by Shawn Furster. He's a senior manager in our tax services group. Shawn has over 15 years of public accounting experience. And we have Rebekah Flanders. She's a manager in our tax services group as well. And she has over 12 years of public accounting experience. So now they can begin their presentation. Thank you.
Thanks, Katie.
Thank you. Am I good to go? Everybody hear me okay? Great. Good afternoon. Thank you, Katie. We are going to get rolling here with talking about planning and saving for retirement. I hope everybody enjoyed lunch, and as we make the way back in, we'll get rolling here. As we talk about planning and saving for retirement, we thought it was important to first start off our session by just making sure that we're all on the same page as far as what retirement looks like and so forth. So instead of me or Rebekah trying to explain it, what we're going to do is have the experts tell you what retirement's all about. What we can begin to do is we'll start to give a little introduction, and maybe once we get the video up and running, they'll give me the thumbs up in the back, and we'll watch it and hopefully get started here. Before we get too far down the road talking about saving for retirement and planning, we wanted to first do a little bit of review of what the reality of retirement savings currently is in the United States. I'm sure it isn't going to come as a surprise to most of the people in the room here that if you look at most studies and surveys, they show that Americans on average aren't saving nearly enough for retirement, that they're going to need to continue to have the same lifestyle after they retire as they're living up until retirement, which is going to obviously cause them to have two alternatives: either look at what their saving plans are and reevaluate those to catch up to what they need into retirement, or take a realistic look at their retirement and look at what their lifestyle is going to be like and maybe make decisions based off of that. Obviously, maybe having to work a few extra years or work partially into retirement. Dan, are we able to switch back to the presentation? Okay, thank you. Talk about some stats that we pulled down, and we'll just skip those slides. If you look, the Government Accounting Office, which is a nonpartisan group that they work for Congress, they track government spending. They've done studies to show what the current state of retirement is in the United States. And what that showed is that on average, 52% of households over 55 years of age, which is over half, have absolutely no savings for retirement right now. When I say absolutely no savings, I'm not counting Social Security benefits as well as defined benefit plans like pensions and so forth. Really what we're looking at is they haven't put any of their own contributions into 401ks, IRAs, some of the other plans we'll talk about more in the future or later in the discussion. So there is a real heavy reliance on Social Security right now. For individuals at 65 or older, approximately 86% are currently receiving Social Security benefits. Yes. I can see eyes gaze off me over to more attractive here. So of those Social Security benefits that are being received, the average payment per individual is $700 to $1,800 a month. So that's a pretty wide range, but if you look at even the top tier of that average, $1,800 a month for an entire year, that's still under $22,000 a year to provide support in retirement. So that creates challenges, obviously. You add to that the fact that as retirees' life expectancies continue to grow, that's adding more strain and challenges to the Social Security system and to people's retirement and the funds they need to support themselves and continue their lifestyle. Lastly, with regard to Social Security, there's a lot of uncertainty there, obviously. Most experts would say we're not sure what it's going to look like 10, 20, 30 years from now. Certainly probably not going to be paying the benefits it's currently paying unless we have significant reform. So the fact that there's such a high dependency on Social Security right now creates that issue. So, do you want to?
Let me just add to a couple of the statistics, and then we'll switch over here. But so Shawn mentioned 52% of households age 55 and older. So the flip side of that is 48% of households that are age 55 and older have some retirement savings, but that level is only on average $109, somewhere between $100,000 and $150,000 total. And that obviously creates a significant challenge if you're looking at, that would equate to about $405 a month if drawing on that amount as an annuity. So these numbers are just intended to paint a little bit of a picture here for you about what a lot of Americans are facing. And so, we want to move into getting some positive takeouts and takeaways from today, that there is hope for retirement planning and that we can all do something and to start somewhere. So with that, I want to just pause for a moment and we'll look at what experts think of retirement.
What does retirement mean? Retirement is where you reach a certain age where it's more difficult for you to work.
I think it's like when you're in work and you're a long time and you feel like you want to get out. That's what I think.
You get free money from your past work experience and you just get to do whatever you want.
Yeah, it seems fun because you get to go on vacation a lot. You can go places like France and maybe Paris.
Like rest, kind of do chores around the house or like take a vacation to get as far as away as you want from the kids.
All the people that, you maybe went to work and said, looks like I gotta deal with them again.
Retirement is when you think, I've done my part, and you say to your job manager, goodbye, so long. Try to find someone else that's better than me.
I think it is that you're so exhausted. You're really, really exhausted and you're just really tired. When I retire, I'm going to be 26.
You just quit your job and you go home, sleep in your PJs, and probably never get out of your PJs.
Whenever you say, I'm too old for this, and then you sit at home and yell at the computer screen.
Retirement is when you just don't understand why they don't make the buttons on the remote bigger. You don't understand why all these young whippersnappers drive so fast, and your back hurts every time you bend over to feed your dog, and you started getting interested in getting more and more cats, and you said, dang, I'm really sick of all these people at work, and you just want to go travel the world and be by yourself and buy all these clothes for your grandchildren and just have more fun with your life. You don't have to worry about all the ignorance that you used to work with, and you can just go travel the world.
You get some rest in your home.
Like if you want to do what you want to do and you don't want to do work and you want to go somewhere, it's really fun, and that's what I really like.
Mostly, you just lay in bed all day and watch TV pretty much for the rest of your life.
It's when you get too old for your job and you go to a retirement home.
You're probably over the age of 60.
Maybe even 50. I've never actually seen a retirement home.
You're starting a new life again. You're not a pickle anymore, you're a cucumber.
I have no idea.
The pickle is kind of sour, and when you become a cucumber, you're ready for new experiences.
Sometimes you can't do certain stuff because you're too old.
Some old people don't know how to do handstands because they're so old.
You might break a hip or something.
You could home and play video games. You could go to the beach. You could skydive. You could do extreme sports.
Well, one thing that I would do, I would just keep looking for dragon eggs and eat tacos.
I'll just eat tacos.
Hey, we did the same thing.
You just have to focus on yourself, but also you have to keep in your right mind and don't go all wild just because you are retiring.
So my takeaways from that video clip mostly is that if anybody nearing retirement would like a couple cats to add to your collection, I have two, if you'd like them. On a serious note, there are some interesting points in there that we do have to look forward to in retirement. Let's look now at one of the basic tenets of retirement planning, and that would be addressing compounding interest and growth. So we have a primary goal of retirement planning or investing in general. It's trying to balance a mix of a good rate of return with the market or the investment risk. So trying to marry those two and achieve the best possible outcome is where we find ourselves in any kind of investing, in particular retirement planning. So the incentive for us to save and in order to help mitigate these two factors is to use compounding interest to our advantage. Compounding interest in its basic definition obviously is interest that is accumulated and growing on the principal of the account and any reinvested interest from prior periods. So the more often that compounding takes place, the better and the higher growth there is realized in the account. There are challenges of saving, of course, that each of us addresses at different points in our life. Somebody out of college may address all of these, having high student loan debt. They may have lack of access to a retirement plan depending on an employer offering a good plan. So we'll talk about some ways to save for retirement without, if there's no 401k available, and also somebody who finds himself taking home a lower income or less of a paycheck would obviously have a lot of other expenses that come first before thinking about planning for retirement. But what we want to emphasize here is that starting to save early and to save as much as a person can as early as you can is really the best way to look at retirement planning as a starting point. I'm going to flip here to this slide. When any of us is looking at retirement planning, there are factors that we have to consider. We have to think about what is our lifestyle now, what do we want our lifestyle to be in retirement, what do we need that dollar amount, is there a magic dollar amount for all of us? And the answer is no. I mean, there's Mark's retirement account is going to look a lot different than my retirement account or Shawn's retirement account, just depending on how we want to plan and what our life circumstances are over our 40 working years, give or take a few. So we analyze and we assess what is our lifestyle going to be like. We have to think about our expenses. So, even though in retirement you may not have a mortgage, you may not have kids' college to pay for, you may not have other expenses, your expenses may shift into different types. So healthcare is going to be a stronger factor to consider during retirement years. So you have to just think about what buckets your expenses are going to be in and where you're going to end up and where you want to end up for a retirement lifestyle. Do you want to travel? Do you want to try to live frugally in retirement to pass more on to a junior generation? So each of that is very individualized. And then obviously there are changes that we adjust for throughout our different phases of life. Somebody starting out may be able to live a little more frugally if they want to get a head start on retirement planning. But once you add spouses and kids and houses and college and cars to the mix, there's just a lot more moving pieces to reassess and to determine. So let me back up here and just highlight a few examples of compounding interest and kind of how powerful a tool it is that we want working for us. So in example 1 here we have, example 2, I'm just going to skip to example 2. We have friends Beth and Ann. Beth is age 19, and her parents really instilled in her early on that she should start somewhere and save something. So at age 19, she starts to put away $2,000 a year for retirement. We're going to assume a 7% interest rate, and she's only going to save for 10 years. Well, at the end of her time for saving, let's target 65 as her retirement age, she has $361,418 in her account, just by putting away that $20,000 for 10 years. Anne, best friend, didn't start saving until age 29, and she also saves $2,000 a year at the same interest rate, but she's going to save for 37 years. So Anne's total savings are $74,000, and she ends up with a very similar amount, $343,122 at the end of that savings time. So obviously it's clear to see here that Anne's money didn't work quite as hard for her as Beth's did. Let's change the facts just a little bit as in the previous example. Beth is going to incrementally increase her retirement savings every year by just $100. So as she's going to get her, hopefully, raises throughout her working life, as maybe some expenses change, if there's maybe some student loan debt that falls off, if you have a car payment that falls off your plate, then put that money into a retirement account. So Beth Beth is going to defer a little bit more, and she's going to keep saving through age 65. Well, at the end of that time, she's got over $1 million in her retirement account. And I think there are charts in the back of your material to kind of show the calculations for this, but she only was putting a maximum amount away of about $6,600 per year. So as you're getting used to saving for retirement, that's one thing that is an encouragement to a younger person. So her funds obviously are quite a bit greater, almost $800,000 more at the end than Ann's. And the last example that I just wanted to point out here is that even though there's no magic number for retirement, I just wanted to pick, let's say, $1 million if that was going to be somebody's goal for having their nest egg. How much would each person, Beth, Ann, John, and Mary, need to save at ages 20, 30, 40, and 50 years old in order to get that $1 million? Starting with Beth here, she's starting out very early in life. She's only going to save to about $250 a month or $3,000 a year. Her retirement account at age 65 is just over $1 million. But she has only put away of her own money $140,000. Compare that with Mary, who decides to get a start on saving for retirement at age 50, which is fine. Sometimes you just got to start somewhere. At age 50, she's going to put away $2,800 a month or $33,000 a year, which seems like a huge amount. But she is going to achieve $1 million 15 years later. But her funds, she has to put away over $500,000 of her own money. So just it's we all know the value and the power of compounding interest, but it's nice to see some of these numbers thrown out here. Let's just shift a little bit. So we've talked about the motivation behind saving for retirement. Shawn's going to talk about the mechanics of actually doing so and touch base on the account types and some of the specific tax incentives for each type of retirement plan. I wanted to highlight, though, just a little bit of history for retirement plans in the U.S. So in past centuries, we had a mantra, or the typical U.S. worker had a mantra that you just worked until you died or until you physically couldn't handle working anymore. And that was, of course, many, many years ago. There has been a significant shift in the 20th, throughout the 20th and now into the 21st century that as the U.S. economy has grown and it's shifted more into industry and to knowledge workers, that there is going to be the availability to have a retirement option and to have not have to work for your entire life. So previously, it was employers, private sector employers, who kind of started in the early 20th century offering types of retirement plans, and these were the traditional defined benefit plans that I was talking to John Yannick at lunch today, and he said, "Did you know that in today's world, the defined benefit plans are only available to about 10% of workers?" So there has been a complete shift in the last 120 years from defined benefit to defined contribution plans. And that's substantial because that means each one of us, for the most part, is responsible for our own retirement. And any time when we talk about retirement income or any income shift or income discussions, there is, of course, the implication that the IRS is going to get involved and that the government is going to get involved. So that is the case. And this last bullet point here is what I want to highlight, that the government continues to support the shift from employer to employee responsibility for retirement planning, in that it incentivizes and offers tax breaks and tax methods to get involved in retirement plans. And this is where Shawn's going to take over and just talk about some of the specific plans themselves.
As Rebekah noted, there's obviously been a significant shift towards defined contribution plans, which is what we'll start off talking about. I'll start off talking about 401k plans, which are by far the most well-known, the most popular type of defined contribution plan. Approximately 80% of all defined contribution plans are set up as 401ks. With the defined contribution plan, obviously the focus here really is on the contribution aspect of the ability for the employee and the employers to put money in and have that money grow either tax-free or tax-deferred into the future for the employee or for the employees. There is no benefit with this, or no guaranteed benefit at the end. So unlike Social Security and some of the historical pension plans where there's a guaranteed benefit at the end, it's all about the growth of the contribution in these accounts. Interestingly enough, 401k plans weren't originally rolled out or earmarked for retirement plans. They were originally set up for highly compensated employees to defer income. But there were some modifications to the Internal Revenue Code in the early 80s, and then it really started to steamroll, and this became the main vehicle for retirement in the early 80s. So the 401k plans are generally set up by the employers with 20 or more employees. They do, generally with these plans, they do come with a matching contribution for the employee, so the employer has the ability to match contributions. Usually it's a certain percentage of what the contributions are being made on behalf of the employee. There are generally vesting requirements with this, so the employee has to meet certain employment requirements to be vested in the contributions being made by the employer. The nice part about these plans is the employers usually cover the accounting fees or the account fees as well as the refiling requirements, so they're pretty straightforward from the employee's perspective as far as what they need to do to participate. And then the nice part for the employers, obviously they get a deduction for the contributions they're making on behalf of their employees. So with these traditional accounts, what it does is, again, it allows the employee an opportunity to defer the tax liability on their income. They choose to make what's called a pre-tax contribution into the plan, so that means the income they earn that year does not get taxed for federal income tax purposes in that year. It gets tax deferred, and the contribution along with the growth on it is deferred into their retirement or whenever they start to take qualified distributions. At that point, when the distributions come out, they're entirely taxable. There are limitations on how much a person can contribute. Based off 2016 numbers, the annual contribution for an individual is $18,000 a year. If the individual is over 50 years of age, there is a catch-up provision where they can invest an additional $6,000 into these 401k accounts. And the overall contribution limit for an individual is $53,000. So this includes when you add in employer matches as well as potentially a profit-sharing plan contribution, other types of incentive plan contributions. The maximum that can be put in on behalf of an individual is $53,000 under the 401k plans. The 401k plans also offer what's called a Roth deferral option. What this does is it allows the employee to put in a post-tax contribution into the plan. So in this situation, they are still paying tax on the income they earn that year, but the contribution goes into the qualified plan, and that contribution, along with all the future growth, is tax-free. So in retirement, when they take the distributions out of a Roth 401k account, it's not taxable to them. So that's a huge benefit in being able to avoid federal taxation on the growth of that contribution. Obviously, the compromise there is you're not getting the current tax benefit by getting the deduction with that. A few other notes with regard to Roth 401ks as well as traditional. If there is an employer match with a person that has chosen to do the Roth IRA, the Roth 401k, the employer match still goes into a traditional or pre-tax account, so those distributions and the growth would still be taxable to the employee when they take the distribution out in retirement. There are required minimum distributions with these accounts when the individual turns 70.5 years of age. Unless they're still working, then they can continue to defer it longer. And lastly, with the Roth IRAs, or Roth 401ks, they have the same contribution limits as I noted earlier. There's also solo 401k accounts. These aren't as well known or popular, but there are options for sole business owners and their spouses where they have the ability to set up a similar plan and make a contribution up to $53,000 or earned income, whichever is lower. The nice part about these plans is it provides an opportunity. Say the individual works for an employer and also has their own business on the side. They can participate in both plans, and the two limitations aren't intertwined, so they have the ability to utilize limits under both and potentially really put away a lot of money into these types of plans. Move on to talk about a couple other defined contribution plans briefly. There's what's known as a 403B plan. These plans are offered by public schools, colleges, churches, certain other 501c3 organizations. They are very similar setup to a 401k, very similar requirements. They offer Roth deferrals that we talked about with 401k. One unique thing with the 403B plans is they provide an accelerated catch-up. I mentioned earlier 401ks, you can put an additional $6,000 in an account if you're over 50 years of age. There's a 3-part test you go through under the 403Bs, but you can, assuming you meet the fact pattern, you can put as much as $15,000 in as an additional catch-up under this provision. Another plan, again, very similar to the last two, is a 457B plan. To qualify this for tax CP, we have to throw out as many Internal Revenue codes as possible, so there's a minimum of those. So this is authorized under 457B, and again, it's similar to the last two plans we talked about. It's for government, non-government entities, as well as certain tax-exempt entities. Again, offers similar benefits. The one distinction with this is unlike the other two, the first two we discussed, where there is a fairly substantial 10% penalty if the individual has an early withdrawal, that before 59.5, that doesn't apply for the 457B plans. So when we want to talk about IRA accounts, these are probably more well-known than some of the last couple ones we talked about. These are more available to individuals. They are not plans that are set up by employers. These are all set up by individuals. Anyone under 70.5 has the ability to set these plans up and contribute in. What these plans allow is a lot more control of the investments for the individuals. Under the 401k plans, employers usually offer a limited amount of investments to choose from. Under this plan, the individual truly has the control of their investment funds and where they want it to go. With these accounts, again, there are traditional and Roth IRA accounts. So under these limits, you can make either a pre-tax or a post-tax contribution into the plans. I guess the hurdle with these, or not a hurdle, but the restriction here is that the contributions into these plans are much lower than 401k. The annual maximum contribution for 2016 is $5,500, and the catch-up's only $1,000. So it's not you can't put as much money into these as you can with 401k plans. And there are certain phase-out thresholds with regard to getting a deduction for a traditional IRA. Noted on the screen here, $71,000 for single and married filing joints, $118,000. Under Roth IRA, it works a similar way. Individual can put money in on a post-tax basis and allow that to go tax-free. There are limitations for higher earners here as well. $117,000 for single, married filing joints, $184,000. These are to make direct contributions in the IRA. We'll talk a little bit later that there's a way to circumvent this, and that didn't used to be there, say, 10 years ago. So we'll talk about that briefly. And then lastly, important to note that if you're making contributions into an IRA account, they have to be in by April 15th of the following the tax year you want it to be applicable for. So for example, a 2016 contribution would need to be in by April 15th of 2017.
Regardless of whether a return is extended. So what I'd like to do here is just reemphasize some of the points that Shawn made in the comparison between the traditional and the Roth. The traditional 401k, there is tax-deferred contribution and tax-deferred growth. So that means income going into those accounts, not taxable currently, but taxable when it's withdrawn. The Roth element allows the amounts contributed to be taxed first so that the amounts withdrawn and any growth in those accounts, the Roth accounts, are withdrawn tax-free. So, certainly a planning consideration for each individual who may have this opportunity available. Shawn will mention that in just a little bit, some of the considerations of when to contribute to a regular versus a Roth 401k or IRA. And then with the IRAs, the traditional ones, the points that I just wanted to reemphasize here are that the earnings are tax deferred, so taxable when withdrawn, just like a traditional 401k. And there is a required minimum distribution, which must begin at age 70.5, as opposed to a Roth IRA. No required minimum distribution is mandated.
So now that Rebekah reviewed the traditional versus the Roth, obviously when an individual is trying to make a decision as to what makes more sense for them, there's many different factors that need to be considered. And unfortunately, it does require looking into the crystal ball and trying to figure out what things are going to be like when you're in retirement. One of the first things that needs to be considered is income level. What's the individual's income level now versus what they expect it to be in retirement? If they're earning more now than they expect to make in retirement, so they think their income level is lower in retirement, it may make more sense to go the traditional route, get the tax deduction now, defer that tax liability to future years when they expect their income to be lower, and under a current graduated tax system, the lower your income, the lower the tax rate. Speaking of tax rates, that's another consideration. What are tax rates now versus what they're going to be in the future? That's a tough call to make. Generally speaking, many people think the tax rates right now are pretty high. They've been much higher than this in the past. There's been times our highest tax rate right now is about 39.6%. It's been double that before when you factor in all different types of taxes. Based off of what happened Tuesday with the election, there's a large contingent in the tax community think tax rates are going to be going down in the future. How long that lasts, it's hard to know. But again, tax rates does take as a player in this decision making. The use of the funds depends on if the individual expects to use up that retirement account while they're retired and to help take care of those accounts, or is this part of a legacy planning where they're going to ultimately pass this on in inheritance to their children or grandchildren. That's an important deciding factor in whether what they want the tax implications of that to be to those that inherit it. The length of time that the funds will be in the account and expected to grow is a determining factor. If you're starting off early, getting that tax-free growth is significant versus if you're getting a late start. Because it is difficult to look into the future, what we find a lot of people doing is hedging their bets, if you will, and going both routes. They're trying to get some of that tax-deferred benefit now by having a traditional IRA or 401k, getting that tax benefit currently, but at the same time putting money into the Roth option where they can have some income in retirement that's not going to be fully taxable. Because if you have a Roth IRA or a Roth 401k, those distributions in retirement won't be taxable to you versus the alternative.
So let me pick up here and just highlight a couple other types of plans. We have the Simplified Employee Pension Plan, or a SEP IRA. And this type of plan, the next couple ones are just a few of the lesser known plans, but we wanted to highlight them and just touch on them anyway. These type of plans are ideal for small businesses, those generally with 100 or fewer employees, or self-employed individuals. And the key point here for SEP plans is that it's only an employer contribution plan. It's not a pension plan because there's not like a defined benefit plan, because there's no set amount that the employee is going to withdraw upon retirement, but the employer is the only one contributing to this type of account. And then those contributions must be made equally for all of those eligible for these types of contributions. The maximum amounts here are $53,000 or 25% of an employee's compensation, whichever is higher. And because an employee is not contributing to these funds and using their own money to defer, and in which case, when we contribute our own money to our retirement accounts, that part is immediately vested. So for my GYF 401k, anything that the employer contributes was subject to a vesting period on any matches. But with these SEP plans, there's an immediate vesting of the employer contributions. Also, simple IRAs, savings incentive plans for employees. These are similar to SEP IRAs, but they can be both employer and employee contribution based. But the limitation here is that an employer can't offer any other plan. So again, good for smaller businesses with not many employees. A couple other types of plans are that are considered retirement plans that employers could offer are profit sharing plans, stock bonus plans such as ESOPs, and money purchase pension plans. I just wanted to comment on the profit sharing plans. They're usually offered in conjunction with some other type of plan. So with a 401k type plan, an employer would have a set 401k plan offered, and then a profit sharing element in addition to the standard plan contributions that would allow for recognizing employee contribution, let's say on an annual basis that's calculated on profits of the company. Defined benefit plans are the plans that are going by the wayside in current times. They are the traditional employment-based plans that we've talked about that were first came into play in the early 20th century. It's really considered any type of plan that's not a defined contribution plans that Shawn has just that we've just gone through here. And obviously, due to the fact that there's so much cost associated to so much cost to employers associated with these types of plans, they're really not very popular anymore. But a lot of government type plans are still examples of defined benefit plans. KEO plans are ones that I'm just going to highlight briefly. They are kind of a hybrid of defined benefit and defined contribution types. And all contributions to a KEO plan have to be made pre-tax. There's no element to put those in after tax. And the maximum amount here is similar or the same as some other types of plans, 25% of earned income or $53,000. But they're really cumbersome to administer, so they're not very widely used at all. So let me turn it back over to Shawn for just a few notes on some retirement planning for family members and some interesting things you can do if you have family members in a business.
Yeah, it is a common question that we get asked from clients is what are some strategies to help not only do tax savings but have retirement planning for individuals, and we'll start off talking about minors, one way to assist with that, and we recognize that this is a challenge. Start talking about individuals that have teenage children that are able to have earned income, and we know at that same point you've got a lot of challenges going on at that point. You have college education to think about, other types of expenses going on. So for the right people this can work, and we recognize though that this is a challenge, but when an individual has a teenager, for say, that is working, has earned income, that provides an opportunity to set up what's called a custodial IRA account for the minor. What happens in this scenario is the adult, or the parent, or the grandparent has custody of that IRA account until the minor turns 18. What you're able to do in this scenario is have a contribution made on behalf of the minor, either up to the amount of their earned income or the maximum contribution into an IRA, which is $5,500 for the year. There is no requirement that the source of that contribution be from the earned income, so you don't have to convince your teenager to soak away all their money into a retirement account. I can imagine how successful that conversation would be. My son's 12 now, so I'm going to be having, those teenage years are on their way. But what can happen here is the grandparent or parent has the ability to make a contribution on the minor's behalf. They can do it either entirely, they can offer to match the contribution, do whatever, but put the contribution in to the IRA account. Because the levels are well under the taxable gifting limits for the year, there's no issue there, and essentially allow those funds to grow either tax deferred or tax free into their retirement, which is allows that money to grow significantly during their working years. There is the option to have either a traditional or a Roth IRA with this, as we talked about in the past. The nice planning tool with this is if you choose to go to the Roth IRA account, which again is the money is considered to go in post-tax. Assume that the minor earns $5,500 a year, so they have earned income, they put the contribution in post-tax. When you account for their standard deduction, however, on their tax return, all that income is going to be offset by their standard deduction, so they actually pay no federal income tax on that contribution. It's considered to go in post-tax. The growth of that's all tax-free, so essentially you've avoided the federal income tax on the contribution as well as the future growth. The risk with these is obviously they do turn over to the minor when they're 18. So at that point, the minor has control of the account. So you have, hopefully they're responsible and they value that investment and continue to not touch it into their working years. But to the extent that they do, they can pull the money out, and there are pretty substantial penalties. We talked about earlier, 10%, as well as the taxability of those contributions that can offset the benefit that was gained by putting that money in so early. Just to demonstrate how powerful this could be, if you account for the compounding growth that Rebekah talked about, if you have two friends, they're both 15, they both start working at the same age, and the example I have in the materials, example 7, Ben and Jerry, again, both start working at 15. Jerry's family has a little more has resources to put the contribution in on his behalf, so they start putting in the $5,500 contribution at that age and allow that to grow until he eventually takes it over and continues to make the contribution. Ben, on the other hand, he starts making the contribution at 25, so he's 10 years behind Jerry. They continue to make the same $5,500 contribution into the IRA accounts until they're 55. They retire and begin to start drawing the money out when they're 60. In this scenario, even though Jerry and his family only put in an additional $55,000, the $5,500 over 10 years, it accounted to a compound interest more than double the account value at 60 years old in retirement, $928,000 more in his retirement account because of that extra 10 years of compounding growth. So again, I know it's difficult to think about retirement for your teenagers, but this is a pretty powerful example. Just touch briefly on some other, not necessarily retirement planning per se, advantages with employing spouses and children, but one thing you can do if you have the ability with a family business to employ spouses and children is fairly easily provide them with the earned income that is generally needed. We've talked about that. That's a hurdle to put money into retirement accounts, so you have to have earned income. You can employ your spouse and children. Be careful not to be too aggressive with this. It is important, and the IRS will be skeptical for when there's a lot of family employment businesses, so you have to make sure that you are paying them for their for services they're qualified to perform, as well as they're paid reasonable. So you don't want to be paying your 12-year-old or 14-year-old to be a delivery driver or something like that, where they clearly can't be doing that, or paying your daughter $6,000 to come in one day to sweep out the office. So those are certainly concerns that you just want to make sure you document everything properly. There are additional employment tax savings and income tax savings. I'm not going to get into those a whole lot in an effort of time to stay on track, but when you employ your spouse and children, you can generally avoid or minimize employment taxes that they're paying, as well as potentially move some income down under the right scenario from the highest paid taxpayer, which is probably the parents, well, not probably, but down to the children who are paid at a lower tax bracket. With that, I'll pass it on over to.
So I'm going to take over here and talk about a couple other special considerations. Taking loans from retirement accounts is sometimes an option for a certain employer-sponsored plan, but that should be a last resort for folks for obvious reasons. If you take the money out of the account, you can't enjoy the growth within the account, and there's always the risk that that money will never be put back in. If it's not ever put back in and repaid to the account, then it's treated as an early withdrawal of those funds, and I'm going to touch base on what those implications are in just a second in a couple slides. But if you've exhausted all other options and somebody finds themselves needing to withdraw funds from a retirement account, then you just have to proceed with caution and look at the character of the funds, make sure that they are a loan and not a withdrawal, make sure that there's paperwork to document the loan and that the terms are set to be repaid. Think about how long you're going to be with a current employer. So it would create a significant headache to change employers if it's an employer-sponsored plan to take a loan and then have to roll over the funds into some other type of an account when you have a loan outstanding. The only other point here that I wanted to highlight is that the loans can be taken from qualified accounts. So these are the employer-sponsored 401ks, 403bs, those types of accounts, but not from IRAs. A loan cannot be taken from an IRA. It would immediately be classified as an early withdrawal, not a loan, if funds are withdrawn. If the funds are withdrawn early, so that's any type of withdrawal before the age of 59 and a half, then there are significant tax ramifications of withdrawing those funds. So the owner would be assessed a 10% penalty on all funds withdrawn, as well as a regular income tax on any of the funds that don't have basis. And the basis in the retirement account is obviously the funds that are put in on an after-tax basis. That's what we mean by basis in a retirement account. But any funds withdrawn that were put in pre-tax and any growth on the account in an early withdrawal situation is subject to both of these levels of taxation. I had experience with this a few years ago. Bob Grossman and I had somebody come to us with a situation that they withdrew. They were somewhere around the area of 50, 55 years old. They took out $375,000 from all of their accounts combined. And I have here that it's just their retirement accounts, but it was also some kids' college accounts. A bad situation to be in. They knowingly withdrew all that. They knew it was an early withdrawal, but they tried to put that money then into a vacation rental property, trying to build it for family use, but also for an investment property and income. And were completely caught off guard when they needed to stroke a check for $142,000 on their tax return. So that's 44% of that $375,000, because not only were they assessed a penalty, 10% penalty on all of that. It was $325,000, not just there was $50,000 of basis there, but it threw them then into some higher income tax brackets as well. So just a really unfortunate situation for them, and something that they weren't expecting. So there was really nothing that we could do at that point except hand them a tissue and say, I'm really sorry that the tax is this high.
I want to pick up and talk about IRA conversions. A couple points here. Earlier I mentioned that there were some limits on the ability to contribute into a Roth IRA. There is a mechanism now to circumvent that. Because of the income limit that existed, again, there was an ability for an individual to put money directly into a Roth IRA. Prior to 2010, there was also a limit on the ability to convert from a traditional IRA account to a Roth IRA account. As part of some stimulus packages that were passed in that year, they did away with that income limit to do the conversion. So there's still a limit to make a direct contribution, but there's no longer a limit to do a conversion. So what we have taxpayers doing is making a contribution into a traditional IRA account and then immediately converting it over to a Roth IRA account and getting the deferment there. With regard to IRA conversions, when we talk about doing that conversion, again, individuals have the ability to, if they've been investing in a traditional IRA account, and it makes sense for them based off of their review of their retirement planning to convert that into a Roth. There are obviously significant tax implications there. The conversion will be taxable in the year it is converted. So obviously careful planning from tax planners and investment advisors need to occur there if that's being considered. Once you do that conversion and pay the tax on it and move it into a Roth, there is a 5-year period in which those funds must remain and can't be moved around. The only kind of redo you get is there is a recharacterization option. So if you've done the conversion, and we had this with one of our clients a few years ago, they did a conversion, they converted a $250,000 traditional account to a Roth account, and say it was in 2014. Prior to filing your 2015 return on extension, so you get through October the following year, you can make a decision to basically undo what you did if it makes sense. In this situation, the value of the account had dramatically dropped. So you did the conversion, he was going to have to pick up $250,000 of income on the return. The account dropped to $180,000. It no longer made sense to do that. So we recharacterized the contribution, and the only difference with that, once you do it, there is a 30-day period or the remainder of the tax year that you can't try to flip it again, but it's definitely makes sense in that type of scenario. So with that, we just wanted to refresh on the closing thoughts we've talked about here today. With the state of the retirement in the United States, obviously it's important more now than ever that the individuals look at their own retirement accounts and not just hope that they're going to be taken care of in the future. It used to be the case with Social Security and pension plans. Everybody really does need to be doing their own planning and making sure they're going to have what they need to live the lifestyle they want into retirement. Rebekah touched on the power of the compounding interest. Hopefully, individuals have the opportunity to start saving early. It's tough in those early years when you're getting married, having kids, buying houses, those types of things, but it is critical to start early. If you have got a late start there are the catch-up provisions out there we talked about for both the 401k plans, the IRAs, those types of things. Lastly, just the importance of evaluating your needs and not just pushing it off to the future. It's difficult not to procrastinate and think about retirement. No one wants to think that far down the road, but it is critical.
So the point to drive home is that you plan, you execute, you adjust, and you do that over and over and over throughout your working life. Whenever new situations come up, whenever financial changes happen, you just keep assessing and determining what adjustments you need to make. So if you've done all that and you're going into retirement, here are the things, looking back at our experts, what you have to look forward to. You do get free money from past work.
Get to be exhausted all the time.
I don't know how that's different from where I am now.
Exactly.
But you get to lie around in your PJs and watch TV.
Probably my favorite one. You're allowed to have more and more cats.
Again, I have 2. Anybody who wants any, I have 2. You yell at your computer a lot.
As well as have much bigger buttons on your remote and you can never work it.
And you're not a pickle, you're a cucumber. That was a new one to me, but I'm gonna plan on doing that.
And sit around eating tacos all day long. So with that, thank you for your time today. Me and Rebekah will be around during the breaks to answer questions.